My name is Jeffrey Kennedy and welcome to Trader's Classroom. It's been a while since we've done some practice exercises and labeling price charts, so I thought that's what we would do for today's lesson. But more importantly, we're going to be practicing labeling price charts of cross rates. So let's begin. Now the price chart in front of you is the euro pound, and what I want you to do is just pause the video for a few moments and take a shot at actually labeling this price chart. And then I'll walk you through the process I employ whenever I'm looking at a price chart, sometimes for the first time. Okay, well, welcome back. I think the first step that I would really recommend you to do when labeling a price chart, because I know many times people feel that the wave principle is very confusing and very difficult. Well, it can be, but it doesn't have to be. And certainly with a little bit of practice, it actually becomes easier and easier. Well, the first thing that we want to do whenever we're looking at a price chart is to identify price action as either motive or corrective. Okay, very important. The wave principle classifies price action into two modalities. You have motive waves, and those motive wave patterns are the impulse wave and the ending diagonal. And then you also have corrective waves. You have zigzags, flats, and triangles. Everything else about the wave principle is built upon those five core patterns. For example, a running flat or an expanded flat is nothing more than a variation of the flat pattern. Running triangles, expanding triangles, contracting triangles, those are nothing more than variations of the triangle pattern. Even corrective combinations, all they are, they're simply a variation or an extended correction, if you might say. So the first thing to do, again, identify price action as either motive or corrective. Now, a corrective price action is going to be slow and sloppy and choppy. Now, impulsive waves or motive waves have a totally distinct separate personality. On this price chart here, let me go ahead and identify the corrective wave patterns or the corrective price action. Well, corrective price action, again, slow and choppy, sloppy, many times contained within parallel lines or most often contained within parallel lines. Impulsive price action is very sharp, or motive waves tend to be very, very sharp. So essentially what we have here on this price chart of the euro pound is we have a period of congestion right here. So this is most likely one of the three types of corrective wave patterns. Then we have a sharp decline. This is exactly how a motive wave should unfold. Very sharp, where prices travel very, very far in a very short period of time. Now this price action here, it gets a little bit confusing because it's essentially a sideways price move. We really don't do too much price action here that looks like what we previously saw into the low. Well, if you look a little bit more closely, this last dive that we actually saw in this issue here has a distinct wedge shape to it. Okay? So these are just some basic observations of this price chart. So what we have over here to the right is essentially a falling wedge. This price action here, definitely a counter trend move or a correction. This move right here, clearly an impulsive decline or certainly a motive wave of some type. And then what we have on the subsequent price action right here, which is clearly noticeable, is we have a move up, a move down, and then we have another move up. Okay, so these are just my initial, say, observations of this price chart. So the first step I would recommend you to do when labeling a price chart, of course, is number one, I classify price action as either motive or corrective. Step number two, once you identify price action as either motive or corrective, for example, we'll begin with this price chart here in the yellow box, then we assign an Elliott wave pattern to the formation. So we've identified this as a corrective move. Now we need to identify or determine whether it's a zigzag, a flat, or a triangle. Well, if we connect some trend lines here, and let me clean the price chart up a little bit. If we connect the trend lines or connect these extremes here, we see a price move contained within converging trend lines. Okay, of the three types of corrective Elliott wave patterns there are, the zigzag, the flat, and the triangle, which one does this best fit? This is going to be a triangle. Now, what you need to know about triangles is that they may only occur by themselves in the wave 4, wave B, or wave X wave positions. We'll come back to that. So this is a triangle. Then we have a clear impulsive decline, say waves 1, 2, 3, 4, 5. So this is a nice 5-wave move to the low. Then we have this structure, up, down, and up. Well, price action tending to that is contained within parallel lines tends to be a correction, and this pattern right here is really best identified as a zigzag. If we're working with a flat pattern, wave B should end at or near the origin of wave A, and that doesn't in this instance here. So we have a triangle here, a zigzag, and of course this falling wedge. The only pattern that really best fits out of our 5 choices is that of an ending diagonal. So let's take a look at another price chart here where I actually have price action labeled. Here is 3, triangle 4, 5 of 3, ABC up, zigzag 4, ending diagonal wave 5, and we appear to be working an impulsive structure to the upside, in which I'll be expecting prices to more than fully retrace the ending diagonal, because that's how price action following an ending diagonal tends to resolve. Very sharp, very swift, back to beyond the origin of the pattern. Now, why didn't I simply label this as, say, A, triangle B, C, X, and then maybe another corrective structure? Well, price action is the only thing that can confirm an Elliott wave count. More importantly, if you're going to utilize the wave principle, it's important to do so properly, and some of the things that you need to look at whenever you're labeling your price charts is examine substructure and also market personality. What do we know about triangles? Triangles can only occur in the wave 4, B, or X wave position by themselves. Also, ending diagonals may only occur in the 5th wave position of an impulse wave or wave C of an ABC structure. So really, by the process of elimination, this is really the most logical interpretation for this sell-off in the euro pound. Now let's move on and take a look at another price chart and start the exercise again. Pause the video, take a look at this price chart, and then we'll actually label the price chart. Okay, well, welcome back. Well, clearly what we're seeing in the dollar yen, big move to the downside, very sharp. Prices travel very far in a very short period of time. So odds favor that this is an impulse wave. Now let's look at the other part of the structure here, the other part of the pattern. Well, what we have over here to the left is we have a down move, and then we kind of have like a messy type price action. That's kind of like a professional term, messy, okay? You could maybe move the move up here, or we simply go sideways in my opinion, but we have a distinct down portion, definitely consolidation, followed by another down. So we have a down, sideways, or messy price action, and then down. And then the subsequent price move here is we have an up move, down move, and then the move to the upside is very laborious, very anemic. I mean, it's struggling to make new highs here, but it's a distinct wave in and of itself. So we have this kind of a formation. Okay, well, hopefully the pattern is beginning to evolve and take shape and right in front of you. And all you're really doing, again, is you're starting with step number 1, is price action motive or corrective? Okay, if it's motive, what's the wave pattern that the price action best fits? If it's corrective, what's the wave pattern price action best fits? Well, there's one wave pattern of the basic or core 5 called the flat correction. It starts with a 3-wave decline that we identify as wave A. It's followed by a 3-wave move back to near the origin of the wave A, sell-off in this instance. And typically we'd like to see about a 90% retracement, and this certainly qualifies. And then that's followed by a 5-wave move to the downside. So that being the case, we can now begin to identify this as waves A, B, C. A, B, C, here's an ending diagonal in the wave C position of an ABC structure. This is a 5-wave decline. So from an Elliott wave perspective, we can now sit back and actually identify this as, say, WXY, That would be a corrective combination for our wave A. Here's our A, B ending diagonal wave C for B. So A down, B up, 1, 2, 3. Most likely some type of consolidation here over the next few trading days, something that would actually match this consolidation. So we're going to go sideways for a little while and then probably push a little bit lower down to this 116.47 target, which is simply where wave C equals a 1.69 multiple of its corresponding wave A. Very simple. And again, the ease of which I'm walking you through these price charts really comes with time and practice. Okay, now let's take a look at another price chart. This one right here. This is the Euro Yen. Take a look at this price chart, and again, just pause the video and take a shot at labeling this price chart. Okay, well, welcome back. Now, first, this may be kind of confusing. You might be looking at this price chart and go, okay, I see an initial move down here to the downside, then up, then back down, and then up. So you might be inclined to want to call this, say, ending diagonal, possible. Okay. And then the move to the upside here, you might be thinking that's simply like A, B, C, or a 1, 2, 3 to the upside. Move down. This subsequent advance here is very corrective. So we can easily just go ahead and identify this as a counter trend move because it fits the personality. Notice the slope of this current decline here. Prices travel very, very far in a very short period of time. Here, not so much. It's been almost 2 months now in the Euro Yen, and prices really haven't changed that much. It's been very laborious, but more importantly, the move to the upside is indeed contained within parallel lines. So odds favor strongly that this is indeed a counter trend move. Okay, now that we've identified some price action here, for example, this is a counter trend move. This is going to be a corrective wave pattern. Prices here move very far in a very short period of time. That's an impulsive move to the downside. And then we have this sharp advance as well. So odds favor that this is an impulsive move down, followed by an impulsive move to the upside. Subsequent price action, well, we'll come back and deal with that. Okay, now if we look at closely, this is where we begin to look more closely at the patterns and make sure the substructure is indeed apparent. Like for example, if you're going to identify a move as an ending diagonal of any type, whether it's a C wave or a fifth wave, each wave of the pattern really needs to subdivide into a zigzag or a variation thereof, meaning a double zigzag. So I'm not going to really find a flat in, say, wave 2 or wave 4 or even wave 1 or wave 3 or wave 5 of an ending diagonal. We really need to see flat patterns within that structure. Now here, if we begin at the actual high with our wave count, we see a down, up, and big move to the downside. Okay, this is how price action confirms your Elliott wave interpretation. This is exactly how a wave 3 of 3 price move should unfold. Well, there's a tip that I've actually picked up, and well, I've been kind of doing it myself for a while, but Constance Brown in her book, Technical Analysis for the Trading Professional, actually talks about a way to actually identify wave patterns or more easily interpret or count wave patterns by beginning in the middle and working backwards. Here's how we would actually do that. Let's look at this price move right here to the downside in the Euro Yen. This is going to be our wave 3. Probably wave 3 of 3. Okay, well, let's work backwards. Okay, prior to that, we need a 1, 2. Well, that needs to be married up with a 3, 4. So here's our 4. So here would be 1, 2, 3, 4. That would actually argue for another move to the downside. Now notice we have another little up-down sequence here. So this 1, 2 actually goes with this 4, 5 down here. Let me look to show you the next price chart and I'll show you exactly what I mean. So what we actually have are waves 1, 2, 1, 2, 3, 4, 5 for 3, 4, 5. Small truncation here in our fourth wave move. But this counts more nicely as a legitimate impulsive decline versus, say, an ending diagonal with a very, very large wave 1. Now, if we look at the subsequent price action, waves 1, 2, 3, 4, 5, Nice Fibonacci proportions within the structure as well. Then we can see waves 1, 2, 3, probably a small triangle in here, 5 down for A, arguing that this is overall a wave C decline, excuse me, a zigzag decline. So we can go ahead and kind of get an idea here of how far the move is going to go to the downside. Probably, say, the 131 handle. Okay, now if you look more closely at this price chart, you'll notice I've got at this extreme here a label of either wave A or wave 1 or wave B or wave 2. Well, the reason I'm doing that is because I'm not going to show you the intraday price chart or the weekly price chart, so we really don't know. That being the case, you might say, well, why don't you just simply call it wave 1? Well, the reason I don't want to call it wave 1 is because there is no price evidence to support that conclusion as of yet. The reason I don't want to anticipate or identify the decline as wave 2 is because we do not have the information provided by the weekly and or monthly price charts, so we don't know if this is a wave 2. So that being the case, I tend to like to lead off with my least aggressive interpretation, and that would be I want to start off with the interpretation that it's a wave A decline, or a wave A advance more specifically, and that this is a wave B decline. So this is wave A and B until proven otherwise. Okay, when I say until proven otherwise, at what point would we be able to eliminate one of the interpretations and embrace something possibly a bit more aggressive? So let's work with the idea that this is a wave A advance. We're going to be coming back down to about 131 in wave B. And then we'll look for that move, that low to form, and then ideally we'll see something more impulsive to the upside. Okay. Now, whenever that wave B or wave 2 low actually forms, we'll simply come in here with our corrective price channel, and that allows us to identify something more confident or something more distinct. This would be the upper boundary line of the corrective price channel. So when prices do begin turning up, and let me get my arrow in here. Once prices move above the upper boundary line of the corrective price channel, then what we can do is eliminate the wave A interpretation, embrace the 1-2 interpretation, and look for a wave 3 rally. Okay, well, what happens if we sell off to say 131, but then the market actually continues much lower? Well, if that happens, the reason that's significant is that would represent the lower boundary line of a base channel or the corrective price channel. In other words, this kind of price action decisively below the lower boundary line of a corrective price channel implies it's actually a base channel, and that this move to the downside is actually a third wave sell-off. In other words, my interpretation of this advance would actually be incorrect. And it happens. Sometimes that happens. But regardless of how we're looking at this market, whether this is, say, A up, B down, or 1 up and 2 down, or possibly the prior move to the upside is simply all of a wave 3 move, and this is actually 1-2 to the downside, and we're looking for a wave 3 move, even if you look at the multiple scenarios which are applicable at this juncture in this market, 2 things are certain, or at least one thing is certain, and that is that this move here is a counter trend structure. That means we need to have our attention focused to the downside as we move into September. And if we can hold this 131 handle, then the market may offer us a tradable low. If we sell off decisively below 130, 129, then we need to come back and reevaluate. But the overall process of labeling a price chart from scratch is quite simple. First, step number 1, what you need to do is look for motive wave and corrective wave price action. Remember, motive waves are very sharp, just as this is. Corrective price action, very sloppy and very choppy. Once you do that, once you identify either motive or corrective price action, then you need to find and identify the appropriate Elliott wave pattern. Is it an impulse wave? Is it a diagonal? Is it a zigzag or a flat or a triangle? Once you do that, you then can begin to apply numbers or letters to the price action, which then allows you to make a comprehensive or a forecast of upcoming events. For example, in this price chart of the Euro Yen, we know that this move here clearly is a counter trend move. So at minimum, again, at minimum, we can anticipate a decline down to the lower boundary line of the corrective price channel, which would be along that, say, 131 handle. Roughly about right there. That about does it for today. Thank you very much, and I'll see you tomorrow.